These are the physics-based sentiment forecasts for the U.S. stock market, using data as of January 10, 2025. Long-term sentiment remains moderately optimistic, which is one step below the most optimistic level. Short-term sentiment is optimistic, but with some variation expected over the next 3 weeks. There are no flashes of sentiment anticipated within this forecast horizon. Our forecast for U.S. stock market price momentum is for a strong positive trend over the next 3 weeks. If the market fails to move higher during this period, it could signal weakening economic-based sentiment, which increases the likelihood for large stock price declines later this year. We estimate that economics-based sentiment is currently slightly negative and has been declining over recent weeks. The current condition represents a meaningful decline in economics-based optimism compared to conditions in 2024. This topic is covered in our written report. The lower panel shows the physics-based sentiment drivers, which show the natural shifts in investor optimism over the last 52 weeks and the next 3 weeks. Physics-based drivers explain a significant portion of stock market volatility, and we can forecast them several months in advance. The upper panel displays the price of an ETF tracking the S&P 500 equal-weighted index, shown as a dark blue line alongside our measures of return acceleration, which we call the Market Resilience Indexes, or MRI. In early August 2024, the long-term driver shifted to its most optimistic stance, marking the start of a strong upward move in stock prices that lasted for several months. Then, in early December 2024, the long-term driver shifted to a less optimistic stance, coinciding with the end of that rally. This change also anticipated negative signals in technical measures like MACD. Since early December, market behavior has been consistent with the expected behavior of the MRI in the upper panel. We've seen a sharp market price decline, which often occurs at the end of the exceptional macro MRI, as it did in late November. Over the past 6 weeks, the micro MRI completed the down leg of its cycle, and last week, it began transitioning into the up leg of its cycle. The MRI helped explain much of the recent stock market decline. Looking ahead over the next 3 weeks, the long-term driver remains at a moderately optimistic stance, while the micro MRI, now at a very low level, has started its upward cycle. Together, these conditions suggest the stock market is likely to rebound from its current levels. This view is further supported by our forecast of the stock market's price momentum, measured by the 14-week RSI. The forecast, shown as the red line, indicates a sharp rise in momentum over the next 3 weeks, which aligns with the expectation of a market rebound. That said, if the market fails to move higher in the coming weeks, it could be a concerning signal for later in the year. If a major decline needs to occur for economic reasons, such as high stock valuations, tariffs, slower growth, and high interest rates, we forecast a time later this year when the stock market will be more naturally vulnerable to declines. Historically, major market declines tend to occur during periods of naturally occurring pessimism. Check out our YouTube page where we post additional videos, and feel free to contact me with any questions or comments.